stocks selling off in the final hour of trade today. The Dow snapping a 4-day win streak while the S&P 500 and NASDAQ closed at session lows. The MAGA stocks having a tough day as we kick off a huge round of tech earnings. Let's bring in Mike Wilson, the chief U.S. equity strategist at Morgan Stanley. Mike, great to have you with us.
Thanks, Melissa.
Welcome
back.
Well, thank you. We've got the report from Alphabet, and the stock's up in the after-hour session about 1% over what it lost in today's regular session. I'm curious if the rest of tech sort of delivers like this. Do you think that we can hold on to gains? That's enough?
Well, look, I think you guys have said it right. I mean, it just got back in the aftermarket what it lost throughout the day. These stocks have just been tremendous winners for years, not just this year. And look, our view on the market overall is that, we're bullish overall, and we just think there's more upside in potentially some of the laggard areas. And one of the reasons we feel that way is because, quite frankly, the revisions have been much worse. Earnings revisions have been much worse for some of these smaller cap names and some of these out-of-favor areas. And so the downside risk is less there. And when things turn, which we think they will in the economy later this year, there's just more operating leverage and upside in those names. That's not saying anything bad about Google or the large cap growth stocks. They're wonderful companies, they're wonderful business models, but they just don't have the upside potential that some of these other laggard areas do.
So in terms of the upside that you foresee, what's your forecast currently? And I'm curious, in terms of that upside, you're saying that this rotation that we've seen recently to value, that's going to persist? That is going to drive that upside?
Yeah, it's not so much value as you can have growth stocks that have lagged too. Mm-hmm. It's really kind of names that have just not been leading in the past cycle. So whenever you have a recession, you should be looking for leadership change. It's just the way it works. And typically it does revert back to early cycle groups. And so part of those are value areas. So consumer discretionary, some of the banks, some of the really beaten up areas, maybe in the materials space, even energy stocks have been on a tear. I wouldn't recommend diving back into energy given what's going on there in the commodity markets per se.
Right.
But you can see what I'm saying. I mean, the areas that have just been, completely eviscerated have potentially more upside. And it should be a broader market, right? When you come out of a recession, it should broaden out. And that's what we're seeing. We're starting to see it broadening out. And I think it's a healthy development.
Guy, you got a question?
Mike, I'm sorry, Mel. Mike, you've navigated this really well, the broader market. In terms of, first of all, does it matter necessarily what your forecast for S&P 500 earnings are? If it does, what's your number and what's the right multiple given what the Federal Reserve is doing right now?
Yeah, I don't think 2020 really matters that much, Guy. I think the market is already looking past this year into 2021, and so 2021 does matter. For right now, our range is sort of 150 to 160. I could see an upside case to 170 if we get back to work faster and there's no recurrence of the virus. I could also see downside to 140 next year if things really go poorly. But right now, I'd say between 150 and 160. And then we do think the multiple can actually expand further given what the Federal Reserve is doing. To your point, they have, completely taken out, the chance of risk premium blowing out again with their intervention in credit markets directly. And so I think you can trade 19 to 20 times earnings later this year on sort of a 150, 160 number, which gets you to 3,000 as a base case and maybe 3,200 as an upside case.
Mike, I've been long, it's Steve, by the way, I've been long value waiting for this rotation to take hold and longer than a day or two. When you're looking at value and this taking place, what gives you the confidence that it could actually take place this time? And what segments of the value sector, basically, are you thinking will have the most upside?
Yeah, what's different this time, Steve, is that we have a recession, right? So we've been loath to kind of make this sort of rotational call into these cyclical areas, and I would say it's cyclicals versus defensives more than value versus growth, because good parts of value, the defensive parts of value worked beautifully the last couple of years. Those are late cycle areas. So what we're really talking about is early cycle sectors that tend to do best coming out of a recession and into a recovery. And as I mentioned before, that would be things like consumer discretionary, like the banks, like maybe the consumer services area that have been beaten up because of this recession is really centered on that. And then maybe some of the commodity areas could participate as well.
Mike, great to have you. Thank you.
Thank you.
Mike Wilson of Morgan Stanley. Karen Finerman, consumer discretionary. We're talking about sectors that are sort of difficult to understand how this turn happened. We were talking about getting back to normal. For retail, I mean, is curbside pickup going to be normal? Is shopping by appointment going to be normal? Is travel going to be normal? These are all within the sector.
I mean, today they would tell you it's going back to normal pretty quickly. I mean, retail was, on fire today, as well as a lot of those other beaten down sectors. I think there will be a return to normal, maybe not in the next 6 months, but longer than that, in the next year. I do think there will be a return to normal. I just don't know who's going to survive that, whether the department stores are. Someone like a Lululemon, of course they're going to survive and thrive, and their stock reflects that. But so I'm optimistic on one day back to normal.